Hi, good afternoon, everyone, and thank you for joining and attending this webinar. We welcome you to the panel discussion on real estate, rethinking the future of real estate in light of COVID-19. The discussion will be moderated by Vivek Chandy, the Joint Managing Partner of JSA. Before I leave the discussion to the panel, please note that we will take your questions via the live Q&A section on the right side of your screen. So please do feel free to share your questions. Over to you, Vivek.
Thanks, Ritika. So ladies and gentlemen, thank you for dialing in for this webinar today. We have an excellent panel with my three other panelists, not only having risen to the top of their respective organizations by virtue of sheer competence, they also have excellent communication skills, which will make for a great panel. And they are also at the top of the matters that we intend to discuss today. Rohit, based in Singapore, is the Managing Director of Virtuous Retail and was earlier Managing Director of Xander, both organizations needing no introduction. Abhishek was earlier the Senior Tax Partner of BMR and PwC and is now the CEO of CoWrks. Kalpesh is one of the most sought after partners in Deloitte, who the entire real estate industry knows very well. And so you're welcome to ask any questions you want, and Kalpesh will not be sending you a bill for any advice that he provides on this call.
As with you.
I will start by requesting my three panelists to first spend a few minutes, each telling us how the present situation is affecting them, their clients in the case of Kalpesh and me, their industry, and how they are dealing with these issues. We can start in alphabetical order. After this, we will deal with some of the other issues that they raise, giving the other panelists an opportunity to contribute and maybe provide, their advice from another perspective. And we can thereafter discuss some business and legal issues faced by the real estate industry and try and answer any questions raised by the audience. Abhishek, on to you.
Sure. Thank you, Vivek. Ladies and gentlemen, delighted to be amongst all of you virtually. Not a day goes by when someone doesn't ask me the question as to what is the future of workspaces and what is my view on work from home and how it's going to sort of impact the business that I run. So it's almost like, pressing a play button. But the beauty is that the way the world is changing, what I say in the morning is often not relevant by the afternoon and certainly not relevant by the next morning, right? So everything that I'm saying now has been things that I've been thinking about for the last couple of hours, and it might again change. But at a more macro level, the one thing that I've noticed pleasantly is that the narrative is no longer about the existence of jobs, right? I think if we all remember about a year, maybe 3 years back, there was this big debate about how jobs itself will disappear with AI and ML. Today, I think that narrative fortunately has gone away. The focus is largely about whether people will come back to the workspace and how prevalent will this work from home situation that COVID threw us into continue. My view is that, I think the fact that work is not a destination and is an activity has already taken root. I don't think COVID needed to bring that reality to home. Even if you look at some of the larger IT companies, they've always had very evolved work from home policies. And I think while, in my view, and pardon me for saying it, there is some bravado about people saying that they're now going to get X% of their workforce to stay at home and not come back to offices. I think the general perception, if you ask anybody openly, is that the productivity levels have been significantly lower than what they would have liked to be. So in my view, I don't think work from home is going to become anything close to being a permanent concept. Yes, we will see a lot of distributed workspaces. We will see companies focusing on VCP. We will see companies focusing on flexibility. And all of these are really music to our ears. While I can't say that we've not had some negative impact because of COVID as CoWrks, but I think companies like ours, which have a good brand, which have a good service standard, and which have always been very enterprise focused, whether in design or our service offerings, I think this whole emphasis towards more flexibility, more distributed workspaces will only help our business. Even the office market in general, I think if you look at the history after every economic crisis, Indian office market has actually rebounded very strongly. So I don't think this time will be any exception. More importantly, I think the constrained supply of good quality grade A assets in general in the office market will continue to mean that at least till 2025 or 2026, we will have a lot of demand outstripping supply. Just changing gears a little bit on the M&A side and particularly on startup investing, right? Couple of observations, while obviously again deal activity will slow down, we have been, and again when I say we, the different hats that I wear, come up with a few mantras, if you will, on how we would look at M&A. Firstly, I think we're questioning every assumption very, very deeply, right? Not that you don't do it in normal times, but I think we're spending far more attention to every single business assumption. The second is, opportunities are not going to go away anywhere. So while we don't want to be a vulture fund and keep waiting for pricing to drop, we don't also want to rush and look at opportunities because I think the bottom has still not been hit. The third is that I think any M&A needs to be immediately value accretive. Historically, one would have looked at M&A over a longer period of time. I think today, if you're deploying cash, particularly if it's a cash M&A and not a stock M&A, it needs to be immediately value accretive. So I think those are the three quick points I wanted to make. From a startup perspective, very quickly, I think the extent to which founders have innovated and pivoted their business models is absolutely phenomenal. Again, I'm talking more on the Indian context. I mean, we can name company after company which have just so brilliantly dealt with this crisis. And I think there is enough and more capital waiting. The extent of capital that LPs want to put into the Indian market is just unbelievable. And therefore, I think any entrepreneur and founder that has been able to show resilience in this phase will survive. A quick last point, again, this is both a personal and a business philosophy that we've been following, which is how do you navigate trade-offs, right? I think fortunately or unfortunately, when you listen to webinars, and I hope we don't do it in this one, the only mantra seems to be, about resilience and survival. And I think any business that focuses only on resilience and survival is actually not doing it right. Yes, you need to worry about your safety, you need to bring in discipline, but I think you need to also focus on continuity and making sure that you're doing what it takes to be ready for the opportunity. So my sort of last point before I hand it back to Vivek is that while survival and cash management is absolutely critical, I think any business that goes into a mode of completely protecting and closing everything and discounts and all of those things is going to not be in business on the other side of this crisis.
Thanks, Abhishek. That was really helpful and interesting. Kalpesh, why don't you tell us what your thoughts are and whether you agree with Abhishek on all those points?
Thanks, Vivek, and afternoon, ladies and gentlemen. As I see the impact of COVID on real estate, and it's no secret that most sectors in the economy have been badly hit, and real estate in particular has been badly hit as well. But as we look at it, the impact is slightly different across different verticals of the real estate space. So for example, if we were to look at residential segment, I think anyway it went through a slowdown for the last couple of years on the back of some structural reforms in the form of GST, RERA. It was also one of the sectors that got hit by demonetization. And as one looks at the impact of COVID-19 on this space in particular, the first thing that sort of comes to mind is that when there is lack of job security or income security, the chances are that people will think twice about making any large capital decision. And to that extent, I think residential real estate developers will feel a little bit of squeeze for the next few quarters at the very least, till some semblance of normalcy starts returning. Couldn't agree more with Abhishek on the commercial segment. As a sector and as a segment, this is a space that has been growing leaps and bounds. I think our absorption rates over the last several years have been phenomenal. We've attracted as a country a significant amount of foreign direct investment in this particular space. There is a lot of uncertainty and that's not unsurprising at this point in time, given that we are at a heightened perception of fear, etc., given the pandemic, for people to start talking about work from home and the fact that it will be fundamentally different going forward, etc. But at some point, our belief is that balance will start playing itself out over a period of time. Things will settle down. Maybe there is an impact, but it's in the short term, commercial space doesn't get impacted given the fact that some of the leases are more long term. And as these leases and the existing leases sort of start tapering off, the demand supply will adjust itself, and hopefully you will not see any large vacancies. On the retail and hospitality space, I'll let Rohit talk about it, but clearly this is one area which will probably come back into life a little later than rest of the sectors, because even after the lockdown is completed, there will be some aversion for people to be spending time in retail malls and F&B and in hotels, etc. So to that extent, it is going to be a slightly more prolonged story. Some other segments like warehousing, data centers, etc., largely will come out unimpacted. In summary, what are the big picture trends that we see? Liquidity squeeze is going to be very important, particularly in the next 2 to 3 quarters. And businesses will do well, firstly, to organize themselves in a manner that they are able to generate cash and conserve cash to the extent that is possible. That's more on the defensive side. Some extent of consolidation we think is inevitable, particularly in the retail space. I think that trend was already visible over the last 1 to 2 years. It will just get accelerated. Deal activity eventually will pick up because, like I said, at some point in time, balancing out will happen. Money may flow to a fewer developers for better projects, but eventually deal activity will pick up. 2 things that we think corporates and real estate developers can do well is to figure out a strategy, like Abhishek was saying, not only to survive, but to raise capital and be available to make good of the opportunities that will come, because opportunities for sure will come, because in any disruption of the kind of the one that we are seeing, there will be plethora of opportunities both for real estate developers and for sophisticated private equity capital. It's then incumbent upon the different players to make best use of it and to come out of this much stronger. Lastly, there is room for much more to be done from an advocacy perspective. I think the real estate industry needs to really put its thinking cap on in terms of figuring out how they present their story better, because clearly this is one of the largest employment generators in the country. And how do we try and get a disproportionate share of whatever kind of fiscal stimulus that comes out of the country and the government in the next few months? So largely, those were my first initial comments.
Thanks, Kalpesh. That was very helpful. Now, Rohit, we are, as you know, you all own and manage some of the finest malls in the country. But as Kalpesh mentioned, it's a bad time for malls at the moment. So tell us how you're coping and what your plans are for the next 2 or 3 years.
Sure. Thanks, Vivek. Thanks for having me on the panel. Good afternoon, everyone. So I think firstly, we all know these times are absolutely unprecedented, where we have 1/3 of the world's population which is really under lockdown, and all of India has been under lockdown for now over 40 days. The government is obviously going to try to open this up because they are running dry. But I think we will have to wait and watch in terms of seeing how the lockdown is going to open up the economy and what the recovery is going to look like. Whether it's going to be a U, V, seesaw, we don't know. I'm optimistic, having said that we should see a vaccine or a drug in the next 12 or 18 months. And hence, the question that all of us are asking ourselves every day is, what do we do in the interim? Having said that, the disruption in the interim can have really significant consequences to, I think, most businesses who haven't planned from a cash flow perspective and who can't survive the next 12 to 18 months. From a commercial real estate perspective, the idea of a forced shutdown or people asking to actually stay at home and not getting out is very unusual. There's no history of this for the landlord or for the tenant to look at. And this is both legally as well as in practice. So we are going to see a lot of adaptation in this entire commercial real estate space. From a shopping center standpoint, clearly, like you mentioned, I think we have been severely affected. Severely affected simply for the simple reason that our doors have been shut for 40 days. Now, if our doors have been shut, our retailers have not been able to trade, and we are at the end of the day a function of whatever is being traded, and our occupancy costs and rents are derived from there. We and most other retail landlords, as per my conversations, have been receiving multiple emails, letters, notices for rental relief during the lockdown. I don't think this is only an India phenomenon. Even globally, I think over 80% of retail landlords have got similar requests for rental rebates or reliefs. April payments is really going to be the test, really the litmus test in terms of seeing what happens after the billing cycle gets over. And I think going forward, this is going to be really an emergence of partnership in pain, right? Because there's very little at the end. And how do you share the pain? Each landlord is really going to approach this individually and differently. And I don't think there's one size, nor do I have one recommendation which is going to fit every single retail landlord. The one thing I am certain, and we have always been certain as a group, is the traditional sense of a retail mall is dead, where a landlord is just building and clipping rents on a monthly basis. This business is absolutely specialized, and you need to be a specialized operator to succeed. The landlord relationship, if you take that, however, is one link of the entire commercial contractual chain. Now, what's happening is, as real estate investments, we are built on multiple related contractual obligations. So if one link within that entire chain breaks, then that's going to have cascading effects on the entire chain in terms of contractual obligations to other parties and how the contracts sort of play out. In the most obvious case, if a retail or hospitality provider is not getting rent or revenue, then they're going to have obviously difficulty in paying the banks and paying vendors and paying employees, and obviously the list goes on. Dialogue will need to be had with banks, and I think most people are already doing that in terms of trying to figure out how they can get relief programs, whether it's through deferment, whether it's through moratoriums, whether it's through cash-only mortgages, whether it's through top-ups, which can be funding the EMIs for the next whatever, 6, 12 months. Having said that, I think the banks can only act if the RBI does something and the government steps in. So to me, this problem for most people who don't have parent support or who are not adequately capitalized, I think the problem cannot be solved only between the landlord and the retailer. There has to be outside interference from the government to ease cash flow. So if you put all of that in perspective and say, okay, how is the retail real estate sector going to look over the next 12 to 18 months, assuming the drug is there and all of that? I think India is going to pick up sooner than every other country in the world, and maybe China as well. We are a country which has very, very few public spaces, and most people outside work in homes have no other place to go to hang out, to spend time, to socialize. So retail shopping malls are not dead, clearly. But like I said earlier, you need to be a specialized operator to succeed and win. From an investor standpoint, our business really, I think, or any investor, their business day in and day out is really how do you price risk. The one risk which no one factored or no one priced in terms of when they were making a deal or trying to price a deal was the entire COVID situation. Right? The uncertainty has made it even more difficult for an investor to be pricing risk and figuring out what is the right price they need to pay. So I think just from a short-term standpoint, if you look at activity between the between PE and M&A, there's going to be a bit of a lull. But having said that, I think once there's more visibility in terms of where the vaccine drug is going to be, things are going to improve and speed up. But the one thing we need to keep in context here, compared to the last financial crisis, this time there's been a lot more people who've been cautious before the entire COVID happened. there's been a lot of cash, a lot of dry powder on the sidelines playing wait and watch. So like Abhishek mentioned, I think there's a lot of capital. A lot of the capital is cautious, but the capital is there and it is going to go to good opportunities, good promoters at the end of the day. So yeah, so Vivek, I hope I've sort of captured what I think in terms of COVID, the retail market, future of retail, and where the M&A private equity play is going to be.
That was a superb introduction. Now we'll get to some more detailed questions. Before that, as the only lawyer on the panel, so to speak, I'm just going to deal with some of the issues that are coming up every day. One is the issue of force majeure, which we'll touch upon. The second is the issues between tenants and landlords that one of you all referred to. Then suspension of construction projects and difficulty in getting the workers back. And of course, delays in the M&A transactions. As far as force majeure is concerned, typically, any contract will have to be performed fully, and any non-performance can be called an event of breach. However, after entering into a contract, if its performance becomes impossible or illegal, then such contract becomes void, and it's avoidable actually, and its performance can be avoided. It's also what is called as frustration of a contract, and it's provided under Section 56 of the Indian Contract Act. Now, when the performance of a contract is excused on the ground, the question here is whether a contract can be excused on the ground that it is commercially impossible or there's commercially hard to perform. That is the issue that courts have continually held that a party cannot plead. But there are certain arguments that can be made, and we believe that this is a matter that will come up before the Supreme Court before long, because there's no precedent on the subject. And that is something that the Supreme Court will really have to deal with sooner rather than later. The other issue is about, landlords and tenants, and, whether one can stop payment of rent or not. Now, I want to just give you a simple example. The first is, now if I bought a property, say 4 months ago, I would never be able to go back to the seller saying force majeure and give me back my money. Similarly, all around the world, I was talking to counsel in the UK earlier. People sell leasehold interests. So you buy an apartment, say with 50 years of lease remaining. So in all effect, it's treated as a sale, but you bought a leasehold interest. Now, though you've bought a 50-year lease, you can't go back and say force majeure, give me back some of the money. Now, on the same analogy, if a lease is executed for 5 years, it's what you call it as an executed contract. The parties have agreed on everything. Though the rent is staggered over the period of 5 years, the fact is that it's going to be very difficult to go back and say now on this executed contract, because things are difficult, because I can't enter my office, that I'm going to claim force majeure, I'm going to claim, that there's some hardship and avoid my obligations. So that is the first principle that, people need to bear in mind. So while we believe that, it's important that the landlord and the tenant, speak and try and come to an amicable settlement, the fact is that the position is that it's difficult for tenants to avoid their obligations because of the provisions of the Transfer of Property Act. Last is you were talking about the M&A transactions. We are seeing 2 or 3 different issues. One is, matters that were going on. We are, it's difficult to get data rooms together. Diligence is becoming more and more hard. In some cases where we've got finalized documentation, executing the documents is more and more hard. In cases where documents were signed, people are now looking very carefully at the material adverse, the MAC clauses, to see whether there is an out. People are looking at seeing whether they can now get price adjustments, because things are difficult, and most people who are coming up are all trying to get out and say that they want a lower price. In some cases, we're actually seeing renegotiation of executed contracts. And then, of course, everybody's looking at indemnity clauses and limitations on liabilities, scopes of indemnities, and the rest. So these are really the issues we are seeing as far as lawyers are concerned. I have one question that I'd like to raise to all three panelists, because it's something that's been coming up, and it probably be of interest. That is about business interruption insurance. Now, most hotels and large businesses all have business interruption insurance policies. Now, however, we are finding that the insurance companies are saying that we will not make payment because the fine line says there has to be the capital asset has to have been compromised or damaged before they can make payment of business interruption insurance. I want to ask all three panelists if this is something that they have looked at and what they are finding.
Should I go, Vivek?
Yeah, please.
So we've looked at this in a lot of detail, and I think before the entire COVID thing sort of broke out in India, even at that point of time, we looked at the entire business interruption, which is really loss of profit and how do you protect yourself, right? As retail malls, the insurance that we take is a IAR policy for operational malls. IAR because you have a multiplex and you are covered under the industry notification and guidelines. So in addition to the IAR policy, what you take is a business interruption policy. Now, the business interruption policy has a bunch of exclusions. And one of the exclusions which is given there, and I think this is standard as part of any IRDA policy in India, where if there is been a shutdown in the event the government prohibits you to enter, then that is covered, and it's a caveat and it's an exclusion as part of property. Like you said, the only current insurance which is available in India is if there's a damage to property. Only then can you avail this entire business interruption or loss of profit. So we in fact went one step further and we sent a notice to all of our insurance providers saying that we are triggering the insurance policy as per the business interruption and loss of profit. We got back immediately in less than 24 hours from all of our different insurance vendors saying that please read your policy, refer to clause ABC in terms of exclusions, and this is not covered. So
just to add to that, my understanding is that Bajaj Allianz has some policy. I'm not holding a brief for them and I've not looked at their policy, but some clients was telling us that that exclusion was not there in some of their policies if you paid some top-up amount. And as in by way of interest, I understand that in the US they are looking at legislation whereby by retrospective effect they'll be able to modify the law to provide that in these circumstances those who've taken business interruption insurance will be paid, and the government will probably top up the amounts that have been paid by the insurance companies. So let's hope something like that happens in India. Abhishek, Kalpesh, is this something that you've looked at?
Yes, Vivek, I mean, I concur with what Rohit was saying. Nothing more to add. I think the exclusions, unfortunately, are what's coming in the way of enforcing any of these policies. So nothing more to add. I think Rohit's covered everything.
Likewise, Vivek, this is what I've heard, but not an expert in this space. Net, I haven't heard of anybody actually having made a claim. So this information about Bajaj policies not having a similar exclusion is interesting to hear.
Okay, the next question that I want to raise is about financing real estate projects in the future. In the past, we were, many PE funds were putting a certain amount of equity and then entering into forward purchase agreements. In the residential sector, they were either getting finances from NBFCs, refinancing from the banks, getting money from funds dedicated to distressed assets and the like. What do you all believe is going to be the source of funding, say 6 months or 9 months from now? Abhishek, I think being.
So Vivek, I think the rules of the game are dramatically different for commercial real estate and residential real estate, right? If you look at residential real estate, and I don't know, even if you go back almost 10, 12 years, barring a few exceptional cases, there's hardly any equity that's come into that sector, right? So every rupee or dollar of capital that's come into the residential sector has been some form of debt or structured debt, right? So whether it's a forward purchase at a discount, whether it's NBFC financing, everything has, I mean, in fact, most times there's not even an attempt for it not to look like a debt-like instrument. And therefore, I think in the current situation, the only thing that can revive the residential sector is that if people take equity calls on the sector, because more debt coming into that sector is not the solution. I mean, we all know it's not rocket science, that debt needs to be serviced. Today, the biggest stress in the residential sector is either that construction is delayed further or whatever inventory you have is not selling. The pressure on pricing is not going away in a hurry. Right. So unless there is someone willing to take a very long-term call and bring in some equity, and I think for that some of the developers will also need to reprice their expectations. And honestly, I don't know if there is too much room left or froth left in the sector from a pricing perspective. I think the residential sector is not going to get capital in a hurry, and I think the distress there is going to get only worse. Of course, we have some of the government funds and some of those funding opportunities, and we had Mr. Gadkari coming up with a suggestion that I don't know if it's in the remit of the government to decide how to tell people how to do business, but I think that sector is going to remain stressed. Commercial, I think like the opening points that Kalpesh and I made, the sector after the temporary setback in this quarter and maybe the next 2 quarters is certainly going to rebound. And I think the levels of equity that came into the Indian market have been unprecedented. And I don't think, once we're over this hump, there'll be any slowdown. Again, the quality of assets is fantastic. The quality of occupiers is fantastic. The way the rental trends are going in most micro markets is great. And this is not just in India. Even if you look at the trends in many of the safe haven and European markets, the rentals are not expected to fall anywhere. And I think in India, you have a huge opportunity for cap rate compression. So I think there's going to be a lot of equity still chasing the commercial sector. And of course, I'll let Rohit talk about retail, but I think the residential sector is going to be the one where they need capital and equity the most, and where the opportunity for that is going to be the most restricted.
Thanks. Rohit, if an organization like we are were to need additional capital, where would you look?
Look, in terms of just to add to what Abhishek said, I think there's definitely going to be more capital sort of chasing India from a real estate commercial standpoint. And commercial is both office, retail, hotels we'll need to see, but that trend is going to continue. So one thing is certain, the trend is going to continue, but the people and the number of people who are going to get the capital is going to be very limited, right? So you're going to have fewer people who are consuming larger of the capital. Most people are looking at investments, at least larger pensions, saying that we want to deploy large checks. So if we have to deploy large checks, then is there a platform we can back? Right? If there's a platform we can back, is there enough skin in the game? Is there enough? Make sure that the partners are incentivized together. So, so having said that, I think definitely capital is going to continue, but the number of people who are going to attract the capital is going to be far fewer. So that's on the equity side. On the debt side as well, I think the trend is going to continue the same way. Most lenders are going to be looking at who they need to be partnering with, who they need to be deploying capital with. So the quantum on the debt side is probably going to go down, but the few people who are good within their sectors, whether it's retail, whether it's commercial, I think they're going to attract far more of the capital. I didn't answer your question, Vivek, in terms of if VR had to raise capital, who would we look at? I mean, it's a mix of multiple people, Vivek. I think one is in terms of what value the capital is going to bring, and two is in terms of what price the capital is. Right? I think these are the two metrics that we all look at when we're looking at a capital provider. So from a retail standpoint, it's in terms of what value that could be very innovative. It doesn't need to be the traditional capital providers like the pensions or the typical private equity. It could be a retail or e-commerce play for all you know. It could be Google for all you know, right? But on the cost of capital, clearly, I think the pensions have a natural advantage there because they don't have fee and promote friction. So yeah, that's the way we would look at it.
Okay. Abhishek, a question to you. Do you think after this lockdown is over and in the months to come that people will choose to work more from co-working spaces as opposed to traditional office spaces? Because I read some article which suggested that less people will need to work from offices, and when they need to work, they'd be able to work more flexibly, and it would be easier to actually work from a co-working space. Do you believe that's the case?
We certainly do, Vivek, and hoping for this to play out. I think, like I said in my opening remarks, people will no longer want all their thousands of employees to come to a single location. I think even independent of COVID, just with traffic and other infrastructure, it was becoming more and more obvious that it's not the best model to bring everybody with 2 hours of commute each way to a single location, right? So I think, and just as a market reaction, even before COVID, we at CoWrks had launched a platform called Go, where we were aggregating third-party spaces. It could be hotels, it could be lounges in hotels, rooms in hotels, extra spaces in restaurants, extra spaces in people's offices, smaller co-working players, etc. So essentially, the whole use case being that you leave home, open the app, see what's nearest to you, and decide to work out of there. So I think the whole distributed workspace need of companies because of this and for other reasons. Plus, I think the whole point about flexibility being the biggest USP, I think that's now hitting home. I think clients are realizing how much value there is to being flexible. Now, of course, it's not that clients with us are on a day-to-day or month-on-month basis, but even if it is a 18 to 24-month lease or arrangement, it's much better than being in a 9-year locked-in arrangement. And I think the other thing is that people had always criticized co-working for the density. I think that's a misnomer. Other than a few players who really created their centers as sweatshops, most of the large operators like us, the density that we have is no different from what somebody would put in their own offices. So I think whatever short-term issues are there, we'll deal with it. And I think everyone used to say, Vivek, from an investor perspective, that there's not enough confidence in how co-working should be valued because they've not seen a cycle. And I think players like us and other more structured players, if they can survive this, then we would have seen not just one but multiple cycles. So I certainly feel very confident of the future.
Super, that's helpful. And while to most people, co-working is really a real estate play. Ostensibly, co-working spaces are really provide technology, and they are technology providers. So, is it possible that companies like yours can actually provide services to people who work from home?
Yes, we do. On a lighter vein, I don't think any co-working company, after what's happened to some of the global players, should call themselves a technology company, because that's actually a bad name right now. But I think more seriously on your question, yes, we have created bespoke offerings, both from a work from home. So whether it is giving a range of furniture options, rentals of laptops, tech solutions, and similarly a BCP package. So yes, I think we are leveraging our technology to make it convenient to work, not just from home, but to work from wherever you can. We're also tying up with one of the world's largest sort of video conferencing companies who will wire up not just our spaces, but also wire up a lot of the third-party spaces that we have on our platform. Because what we're seeing is that even if somebody wants to do a 30 people meeting, they still want to do it in person. They won't get 30 people into one location, but they'll say 5 people each in 6 locations. So the need to wire up those locations with video quality better than just a laptop is going to be a big imperative.
Thank you. So Kalpesh, question for you. What should developers proactively do to manage the liquidity crunch and the likely cash squeeze?
Anything that can free up their assets to be monetized. I think all of us know that the structures in the case of real estate developers tend to be a little bit more complex. So I think just as this whole working from home is happening, if developers can relook at their structures, create an ability for them to isolate assets which can be, if need be, sold out, is something that that is going to be imperative, because one of the things with real estate is, while it is asset backed, creating liquidity out of an asset is that much more difficult given the longer deal cycles. And if added to that is this whole structural issue where sellable assets, so to speak, are sitting in a holding company, that might become more difficult. The second thing is real estate developers need to relook at their businesses completely. This is not time for a strategy that has worked for them in the past, which is to just survive and hope that things will get better. I think you will start seeing several real estate developers being put in a position where eventually they might need to sell assets which otherwise are dear to them. So the emotional attachment to either a price or to any specific asset at some point will need to go, because this is not a challenge that is going to go away in the short term. And therefore they need to be more willing and open, both on the price front in terms of the expectation, as well as on their willingness to sell certain priced assets.
Thank you. So Abhishek and Rohit, if you could go back 90 days and prepare for this crisis, what would you both have done differently?
Rohit, you want to go?
Yeah, I think the first thing that comes to my mind is really have worked more aggressively in terms of getting a war chest of cash, right? So that we have enough headway and leeway to sort of go through the storm, whether it's 12 months or 18 months. I think most businesses in India, especially on the real estate side, if you take out parent support or any of that, don't have that leeway if you look at it only from an asset perspective. So clearly, I mean, the one thing from a I think urgency standpoint in terms of what I would have done. And
so I think
we're losing you.
Yeah.
Losing you. Abhishek, maybe you can start
Sure,
till we get back.
I think I would have done two things, Vivek, one personally and one for the business. I think on the business, would have converted more fixed costs into variable cost. I think this is one aspect which businesses don't pay enough importance to, right? And as CoWrks, on one side, we look at ourselves as really a value added reseller of space, right? So while ideally we would have liked to even convert our rental arrangements into some kind of revenue share arrangements, convert our lease line arrangements, convert our FM arrangements. So if I could go back and change a few things, I would really make sure that we converted as many of our fixed costs into variable. I think that is a lesson learned. Personally, I would have liked to stock up my bar a little more.
So Abhishek, that's an interesting point when you talk about revenue share models in the co-working space. Traditionally when co-working started, it was for more startups and smaller companies. So how would you look at a revenue share model? Because I would think that that's something that Rohit would look at more. No,
it's not really from our clients, Vivek. It's more on the cost side, where instead of having fixed rentals with our landlords, and I think it's not something that is unheard of. If you look at the hotel model, that's how the hotels work, where there's no fixed rent. So I think co-working company is at best an operator, and actually, the property owner should be doing the capex and everything. And if I look at CoWrks as a standalone company, capital is not our strength. Our strength is the running and operating excellence that we bring. And of course, the ability to bring in customers or members, as we call it. So really, just like the hotels have, we should, the industry overall should migrate to that model. And if that's something I could have changed, I would have done it.
And Rohit, are you all looking more at the revenue share model, going forward?
So Vivek, I don't think fundamentally we're going to change any of our leases at this point of time, because no one knows how long it's going to take for the situation to improve and for trading to get back to normal. If at all we decide to give concessions, I think the most prudent way to look at it is really give short-term concessions. It could be for a quarter, revisit every quarter, and then figure out what needs to be done. What the mistake that people do in terms of just getting sort of, I think, bullied by tenants at times, saying that we need to change our entire agreement for the period of the lease for a new format, whether it's a pure revenue share or lower MG. No one knows how it's going to play out. So I think step back, take one step at a time, and start looking at your contracts from a quarter basis. But there's no reason to be changing all of your contracts.
Yeah, and as a lawyer, I can tell you that it's a nightmare registering leases with a revenue share, because typically stamp duty is paid on an ad valorem basis. So we always have a difficulty when we have leases with a revenue share. And maybe that's something that, you know, some of the people on this call may be interested in it and may want to speak to the government about. We've got about 15 more minutes for our webinar. I've got a few more questions to ask the panelists. But in the meantime, may I request those who are, you know, participating to send any questions that you may have to Ritika, and you know, we will try and request the panelists to answer them, you know, within the time prescribed. So let me carry on a question for Kalpesh and Abhishek. Do you believe that the Ministry of Housing and Urban Affairs should include this COVID-19 pandemic as a force majeure event, you know, for the purposes of RERA to ease the burden of the developers? And also, you know, what are the specific stimulus steps that you would, you know, ask the government, you know, to help the real estate industry?
Abhishek, you want to go first?
Please go ahead, Kalpesh.
Vivek, I think relaxation from RERA is almost like a no-brainer, because I think everybody now knows that projects are going to get delayed. This is disruption that is unprecedented, and therefore to penalize a developer for delayed projects in the current circumstances, whether it's by way of interest or any other form, is clearly not the right way to go. And to that extent, I think this is something that certainly needs to be looked at and addressed ASAP. In terms of measures and just focusing more from a tax and a policy perspective, so far, I think if you just look at everything that has been announced so far, it's all about shifting the compliance burden and the timelines from, let's say, March 31st to June 30th, or reducing interest on delayed payments of withholding taxes from 12 and 18 to 9. So big picture, I think too little has been done for the industry, and the expectation obviously is that something is going to happen, and I'm sure the government is calibrating the right time to do it. But from an ask perspective, I think 2 to 3 critical things that needs to be looked at from a real estate point of view. This is a disruption which I think gives us an opportunity to completely relook at our GST structure. Just like how there is an ask for petroleum or for the industry to use this adversity to bring petroleum and petroleum products under GST. Similarly, I think there is a case to completely get real estate under the GST regime. More importantly, I think if you look at RBI policies for last several years, I think they've always been worried about an asset bubble when it comes to foreign investment in the real estate space, and therefore in most cases, including ECBs, there is a restriction on using foreign money to buy land or for undertaking real estate activities. I think the time and the circumstances come now where a look needs to happen, because clearly this is an area that needs urgent attention. Third part is grant infrastructure status to real estate. And again, that's essentially to bring in foreign capital. From a demand creation perspective, I think some incentives need to be provided for incentivizing home buyers, because at this stage, clearly one subsector within real estate that is going to bleed quite badly is the residential real estate space. I think the government needs to do something very, very quickly on this front.
So Kalpesh, will there be any challenges in the tax deductibility of losses incurred during the pandemic? You know, such as the tax authorities claiming that the payments would be of a capital nature, or things like that.
Yeah, I think there is that fear, Vivek, but and the reason for it is, I think, while if you look at it, all of this in the current context that we are, it's almost a no-brainer that if there is any extraordinary expenditure that has been incurred in these circumstances to survive or to do some things, that should be allowed as a deduction. But just mind you that tax audits happen 2-3 years later, at which point the circumstances may be very different. So it's best that at this stage, as many clarifications about these points come in, and this is not just a point for real estate industry. This is across businesses. This is a point that several representations have been made on, saying, look, we understand that the law allows for these deductions, but please make it explicitly clear, because we don't want to be 2 years down the line in an audit facing this as a challenge.
Yeah. So Ritika, I'm going. Thanks, Kalpesh. Ritika, I'm going. Any questions that come up, you're welcome to read them out, and we can ask the panelists to answer. But otherwise, I'll go on with a couple of other questions that I have.
We have a couple of questions, but if you want to finish your questions, and then we can go back.
Please, if they've not been covered, please raise them right away.
There are two questions on the real estate residential sector. One is, when do we expect the revival of the residential real estate sector, and on what basis? What are your views on the real estate broking and property dealing businesses, given the current scenario? And the second one, related to residential real estate, is, do you foresee some price reductions for residential properties, including flats, bungalows, farmhouses, etc.?
I think that's something that probably Abhishek is best suited to handle, because he wears several hats. And Abhishek, any thoughts? I think that's a tough one.
No, so I mean, actually, we don't do any residential within the larger group, Vivek, but I can give you my personal perspective. I think the price correction has already happened. It's happening and will continue to happen. Unfortunately, like I said earlier, given how much debt each of the developers are sitting with, what is not evident to somebody when you look at the pricing is that the interest cost also needs to be priced in. So there's only that much that the pricing can reduce, and just given the limited, low absence of job security, the sort of sentiment from a salaried employee's perspective. I hate to say this, but I think I don't see any immediate, and I say immediate 6 to 9 month revival of the residential sector. It's unfortunate, but I think that's how long at best it's going to take, and it's going to go through a little more distress before it revives.
Thanks, Abhishek. Kalpesh, any thoughts given how much of work you do in the real estate sector?
I echo what Abhishek said, except that I think demand and supply and pure economics need to take over. I think the fall in demand is likely to be fairly steep, and if that means developers have to cut losses and sell at prices that are less than covering costs, I think it might be a matter of survival. But it's going to be a case-to-case analysis for every developer, and it's a question of their liquidity position.
Thank you. Ritika, what's the next question? I've also got a couple sent to me, but what's your next question?
The next question is, how about the hospitality sector? Is finance raising going to be easy there now?
Rohit, is that something that you are able to take?
In my view, I think if you look at the asset classes, hospitality is going to be the worst hit, right? And I keep hearing retail. No, I think in India, especially with the Indian context and globally, hospitality is going to be the worst hit, because all companies have now realized that all non-essential travel is really not required. I think a lot of the work can happen just by video conferencing. And I heard Abhishek say that people are not productive, but I have been doing this for 40-45 days. And I tell you, I'm probably more productive just sitting here than taking a plane and traveling from city to city, right? So I think there's definitely going to be a slowdown in terms of business travel. Obviously, leisure travel will pick up when the economy picks up and people feel safe to travel. So in terms of investors are going to view it the same way. in terms of saying that, okay, if I look at a hotel deal, then how long or what are my cash flows going to play out, and how is it going to play out? So clearly, there will be demand clearly in terms of investor appetite, but I think pricing is going to take a beating, at least in the short term.
Thanks. I can't help agree with you, Rohit. Anybody with any contrary views?
No, I agree. I think hospitality, and I would just add not a contrary view, but I think it's hospitality in its it's an absolute widest context, right? Because it's not just hotels, but as we saw, there are a lot of adjacent businesses around hospitality, and they're all going to go through the same slow revival.
Okay, so I've got one question that's come to me. Someone's having a problem registering documents, and under the Registration Act, once a document is executed, it has to typically be registered within a period of 4 months. Someone's concern is that, it's a large registration and the 4-month period is coming to an end. What do you do? There is a provision under the Registration Act for the sub-registrar to permit an additional period of 4 months if there's an unavoidable delay. Normally, it's based on payment of a fine or a penalty. But I believe in the circumstances, the sub-registry will probably be sympathetic, and I don't see any problem registering these documents after the slowdown is over. Ritika, any other points that any other questions that you want to raise?
Yes, a couple of people want to some light on what parameters would qualify for lease restructuring owing to COVID-19.
So are they looking at it from a legal perspective, or are they looking at it from a commercial perspective, or what? Can you make out the question? Because as I pointed out, typically if you look at a standard executed lease, which is executed in terms of the Transfer of Property Act, it would not be possible for the lessee to contend that rent has to abate during the period of the lockdown or during the period of this commercial hardship. However, if the lease deed has provisions which cast obligations on the lessor, and the lessor is not able to comply with his or her obligations, then it may be possible to contend that since the lessor has not complied with his obligations, that the lessee can seek abatement of rent or negotiate with the lessor. I think when dealing with co-working space, for instance, people like Abhishek will be looking at it from two perspectives. One is if they've taken buildings on lease, the question is they are the lessee, how do they deal with the lessor over there? And on the other hand, when they've executed license agreements or management agreements with the people who take co-working spaces, they are in the position of a lessor, how they will deal with it over there. So it might be interesting to know how you're dealing with it, Abhishek, given that you're really wearing two hats, when running a co-working space.
Sure. So Vivek, I think as you pointed out, the whole substance and form of the two arrangements are very, very distinct and different, right? One is a lease agreement or a license agreement, and the other is a provision of service. So actually, they're not comparable in any manner. So yes, while any business today is dealing with managing its cost and maximizing its revenue, so to that extent, yes, I think every CEO is wearing double hats. But to me, there is no contradiction because the two arrangements are very distinct and different.
It's a very good answer, and thanks so much for that. I think we've come to the end. I'm just getting signals that our time has run out. Want to thank all three of you very much, and thank you, Ritika, for helping with the questions. I think the email addresses of all the panelists are available on this slide, which will come up immediately after we log off. So if anybody has any additional questions, you're most welcome to reach out to the panelists, and I'm sure they'll all be happy to assist. And thank you all very much. Ritika, you want to close?
Thank you, Vivek. We've got some questions, and to the extent we can, respond to some of them, we will ask our panelists to email you if we have your email addresses. As some of the questions are anonymous, but please do reach out to the concerned panelist if you wish. And thank you, everyone, and stay safe.